Let's discuss the risks of investing in the bond market.
The first smell check is the platform SEBI regulated? Are you buying listed bonds? Because if something were to go wrong, you will get added coverage. From a bond perspective, simple things, match it to your investment goals. See what the maturity of the bond is. It is a 1 year, 2 year, 5 year. Are you saving up for your education? Are you saving up to buy a house? Just remember, the lower you go in the rating, the higher risk you are taking. You might get a higher return, but also your risk is higher.
How reliable is credit rating as a metric for retail investors?
Like in any job or anything that you do, there's always a small chance that things could go wrong.
Hello everyone, and welcome to the third episode of Bondstreet, brought to you by Mint and powered by IndiaBonds. We have with us Mr. Vishal Goenka, the co-founder of IndiaBonds and a fixed income veteran. He's been in the industry for very long. The thing is, Vishal, we have discussed a lot of things in the couple of episodes that we did earlier. Goal-based investing being one. Then you started with the basics of bonds, telling retail investors what bonds are all about. The third episode, let's discuss the risks of investing in the bond market. So broadly, if you could just begin the conversation by talking about what are some of the risks that retail investors could face when investing in the bond market.
No, good question. I think usually the benefits of any investment is always highlighted, and I'm very glad we're doing an episode on what are the risks and actually call it out, highlight it, so the investor masses do know what to watch out for. I think firstly, investing in a bond on a platform, the first thing is it makes sure it's regulated platform. SEBI has a very good framework, regulated oversight as to which platform should be selling bonds. So the first thing to watch out that the platform you're investing in, is it regulated by SEBI? And everyone has to mention it below. So, you can go to the SEBI website and you can check where you're going to deal with. Secondly, I think importantly to buy only listed bonds because, again, listing of a debt gives you an added layer of security, a SEBI oversight. It has firm and defined levels of disclosure as to what a company is doing, reporting its financials every 3 months and news. So the first smell check is the platform SEBI regulated? Are you buying listed bonds? Because if something were to go wrong, you will get added coverage on that. Apart from that, I think from a bond perspective, simple things, match it to your investment goals. See what the maturity of the bond is. It is a 1 year, 2 year, 5 year. Are you saving up for your education? Are you saving up to buy a house? And then you can do target maturity. Always find out where the maturity is. Most of the bonds in India, in corporate bonds, is around 3 year to 5 year. It can start from 1 to 5. So do that. There are various options of interest payments. So, some bonds give you a monthly interest payment. Some give you a semi-annual or annual. So people should, again, match it to the investment goals because a lot of people prefer monthly, for example, because they can match it to the EMIs. They can match it to their, regular cash flows. And that's a great benefit. And you should just first see what are you investing in. After that, I think the most important thing is credit rating. And maybe we talk about credit rating. Credit rating is like your CIBIL score for individuals. The higher score you have, the lower is the cost of interest payment to you. Similarly, it is the CIBIL score of companies. An investment grade means there are about 10 credit ratings from AAA to AA to single A to BBB minus. And just remember, the lower you go in the rating, the higher risk you are taking. You might get a higher return, but also your risk is higher. So always match what your risk appetite is. If you want 6.5%, 7% and very happy to do that, you can actually buy government bonds. They're better than FDs and, they're called risk-free. You take a little more risk and go to the AA segment, you can get 7 to 8.5%. A single A paper gives you 9 to 10%, and then BBB, you should be very, very careful, gives you 10 to 12%. I strongly advise people not to buy BBB minus to retail because that is the riskiest of the lot and should be left to professionals and people who specialize in credit analysis and credit investment and not really for retail. So these are some of the risks you should, as a smell test, an investor should take a look at. All the information, it's your money. I always tell people the credit rating report. Understand the company, right? So just do not go by, hey, if this is 15% return, and shut your eyes. Read the credit rating report, read a little bit about the company. Most platforms, even our platform, IndiaBonds, we have every bond, we have a little background about the company. We have the financials of the company mentioned there, right? So you could actually just do a self-help and self-research and, and just read a little bit about the company. I think that'll help.
Okay. High yield bonds and unlisted bonds are no-go areas for retail investors. Would you suggest that?
Unlisted bonds definitely a no-go area unless you're a super HNI and you think you know what you're doing. I'm not saying no to high yield bonds because what is the definition of high yield? High yield is anything probably will start from 9 to 10%, and it changes at the absolute level. I'm saying the lowest risk category or the highest risk category, the lowest rating category is triple B minus. Really exercise caution for retail. So, if you take away the riskiest, then anyway you add an additional layer of safety. Right. Because triple B minus should be really at 14 to 18% and not maybe at 12 to 13, which some people do offer.
And you also spoke about the credit rating.
Yes.
Now, I wanted to bring that in because we have seen defaults and we have seen instances of credit rating, of well-rated companies defaulting and then the rating changing, because the rating agencies say that, hey, we don't get to know unless they tell us. The company is supposed to tell us. So, how reliable is a metric? How reliable is credit rating as a metric for retail investors?
Good question. So, firstly, credit rating agencies are regulated by SEBI, right? So you should know that if you're buying a listed bond, there's an oversight, and rating agencies are regulated. Credit rating is a skill set, and like in any job or anything that you do, there's always a small chance that things could go wrong, right? Similarly with credit ratings, for example, in cases of fraud, a company fraud, there's little that anybody can do, and it's not only in bonds, but we've seen situations in equity markets, which our masses relate to, where if there is a lack of corporate governance or there is a significant fraud or fudging of documents, you can't do much about that. We are not alone in this journey, Shayan. In 2008, this entire global financial crisis, which led to a massive downturn globally, 2008 for like about 15 to 18 months, also somewhere AAA securities or CDOs or collateralized debt obligations went from AAA to default. There were countries like Iceland, which are rated AAA, which went to almost default or restructuring out of the banking sector. So yes, things could go wrong, and it's a good question. I want to address the mindset that people have that, hey, we've had this default, right? You mentioned DHFL, and I think we were speaking earlier about Yes Bank 81. Right. So this session is about risk, so let's address that, right? So yes, we had a default in Divan Housing, and that was a period where India actually was what we say credit cleansing. There was a credit crisis in the country in 2018-19, and post that, a lot of amazing regulatory guardrails have come. In terms of credit rating agencies have been tightened, listing norms by regulator has been tightened, education and information has tightened. The entire online bond platform regulation, which makes people, you can read the documents, was not available at that time. So that was an accident that happened. Again, we are not alone in this, right? So people actually did not have the education and awareness maybe 5 to 6 years ago on fixed income asset class. In developed markets like the US, there's a natural default rate that we talk about, right? So low rated, there's a natural 3 to 5% of all outstanding bonds will default, and these are published by the global rating agencies. Similarly, in India, I think the study is just starting. So we've had 0% default in AAA the last 5 years post the DHFL saga. So I think things were misunderstood. Transparency wasn't there 5, 6 years ago. But thanks to technology and digitization, information is available. I'm going to talk about the Yes Bank 81s. Yeah. Now, that is about education and awareness, because what is an 81? An 81 is an additional tier 1 bond which banks issue, right? In terms of hierarchy of payments, you have senior secured, you have senior, you have unsecured, and then you have subordinated. Within subordinated, just basically just think that if there's 100 rupees to distribute, who is last in the line? An 81 says they are last in the line. Okay, it's called something called a loss absorption feature. So if the bank is not viable, RBI can say that these 81 guys are going to take a hit. The matter is still, I think, sub judice because there is something happening in the court. So I don't want to comment much on that. But Credit Suisse was a large international bank. They defaulted on $12 billion of 81 the last 3 to 4 years. Any economy or financial system goes through a journey of understanding. 10 years ago, we didn't know about equities that much. We didn't know about mutual fund benefits or SIPs. So I think this is a little, 5, 6 years ago was a time when people are understanding about credit. And now I think the situation is much, much better. And I know we're going to talk about it in terms of what are the regulatory guardrails put in place, either with rating agencies or even debenture trustees, and we can talk about that later. So what's happened is happened. I joke and say that in 2021, Nifty was what, 8,000? Today it's 25, 26. No one talks about it, right? That we were a $1.25 trillion market cap and we were a $4 trillion market cap in 4.5 years. That is wealth creation, right? So it does happen in other asset classes, right? It does happen in equities quite a bit. Equities drop 25, 50%, and people say, "Arey, I know about this risk." Now, all we are saying is corporate bonds also have a risk. And what's the session about it? Get educated, learn about it. And you can start from a AAA government security. You can start from a lot of good AA rated papers, state guaranteed papers. Your returns will be definitely higher than fixed deposits, and see how it works before you go right to the high yield at 12%.
Right. There's this default rate that you spoke about in the US, which of course is a much more mature market. Do you think the Indian market is ready for to absorb that kind of default? Secondly, do you also spoke about equities and how that's done well. Do you see Indian investors taking that kind of interest in the debt market as well?
I think it's a journey. I think any asset class. So if I compare it to the Western market, everyone has bonds in their portfolio. When you talk about asset allocation, you talk about, okay, how much equity, how much fixed income, and then maybe alternatives, right? I think in India, our mindset was or has been of a developing economy. When you are a developing economy, a trillion or 2 trillion, the wealth creation hasn't really happened. Today, if you take the Nifty returns for last 1 year, is giving you -2%, right? So the wealth creation when we move from 1.25 to the $4 trillion economy has happened. People want to talk about preserving their wealth now. People want to diversify. Not everyone's going to put everything in equity or real estate. Now, the classic historical ways of doing fixed income in your portfolio, a lot of government schemes and things like that. The problem is that a lot of them have lock-ins for 5 to 7 years. Or people did fixed deposits because that's what our parents and grandparents told us. Ki beta paisa hai, go and do a fixed deposit. It's probably the worst way to invest your money. Obviously, don't leave your money lying in current and savings account. That's actually the worst. But instead of earning 6%, 6.5%, you could actually learn a little bit about it yourself, and make 8 to 9%, 10%. Even if you start in debt mutual funds would give about 7%, you can actually gravitate and say, hey, I'm not going to risk everything. Today, if you have 100 rupees, you want to risk everything. But tomorrow, that 100 becomes 10,000. You're not going to put everything in the equity market. So you're going to balance it with bonds and fixed income. I think on our platform alone, in the last 9 months, we've actually seen a 3 to 4x jump in terms of people, in terms of volumes we are doing. And I think I give it to the equity market because it's done nothing. So people say, what else can I do? We have a very nice lowering or benign interest rate cycle, which means interest rates will go down or remain low for the next 2 to 3 years. Good time to be in fixed income.
So is it the reason why, one of the reasons why people are not so keen on bonds in terms of understanding as well is because the yields and the prices move in opposite direction? Is there some requirement of education as well as when it comes to bonds?
Absolutely. I think education is required. Every financial asset class has its own jargon, as any industry has its own nomenclature. In equity, did people understand what bid-ask is, what EBITDA, price equity, price to earning ratio, and people learned, right? Yield is nothing but returns in English terms, right? So if you buy something cheap, which means you'll get higher returns. So when price goes down, yield goes up. And when you buy something expensive or at a higher price, your returns go down or yield goes down. So price and yield have this inverse relationship. It's simple nomenclature. Uh, it's easy for people to say, hey, a bond is nothing but a loan to a company or a government. People know, loans have existed for thousands of years, much before our times. It's like, people say, okay, give me 10,000 rupees, give it to your friend. That's a loan. A bond is a structured contract. That's all.
Okay. Also, are you seeing a lot of structured debt instruments being masquerading as fixed income? Fixed income is supposed to give you fixed income, whereas these are more riskier instruments. Is that something you're seeing in the market?
So, before 2022 November, the regulation of online bond platform came, and the reason I think some of the regulation came because there's a lot of this technology boom in the country, and people were selling all kinds of things saying this is fixed income. 16% real estate financing and things like that. After and even unlisted stuff, unregulated. So SEBI has been pretty proactive. A, to bring this regulation, and B, last year, actually notify certain platforms that the practices weren't following right amounts of disclosure, or they were doing unlisted online, which is not allowed by regulation in this country. Any industry takes its time. So yes, even now I do see there are two things I want to highlight. So there are still some structured instruments which get listed. My humble request to our listeners today is that first, let's understand what a basic bond is. Securitized instruments, for example, means there is a pool of receivables that somebody else is going to get, which you have a right on, and it's difficult concept for common people to understand. Like on a platform, we don't show any securitized products, any structured products. I think in the recent history, couple of securitized A-rated papers have defaulted as well. It needs real sophistication to understand what does securitization mean. I have a pool of, let's say, 10,000 loans, okay, receivables. If I take the bottommost 500 and put it into the pool, an average guy cannot understand or cannot analyze. So you say, hey, I'm diversified, but it really doesn't work that way. So be careful of structured instruments and securitized instruments. Second risk is a lot of people think that just buying a portfolio of 11-12% bonds is amazing. No, it's not. It's concentration risk. Basically, someone telling you just build a portfolio for small cap equities, then really you're not an equity investor, right? So stay away from these schemes which say, hey, I will buy for you every month or 2 months, I'll buy you a 10%, 11% paper. Because very soon in a year, you'll find you'll have 12 such papers which are triple B, and they're very, very risky portfolios. So do not just get attracted by the high interest rate. As I said, do your study. See if your exposure is all in one industry, and should you really be there.
So what kind of diversification within bonds do you suggest for retail investors? Say buy some amount of GSECs, buy corporate bonds. You spoke about the ratings and what all to avoid or be more cautious about. So if you could just give us some idea on the diversification strategy.
Firstly, I think in your investment portfolio, 25 to 30% should be fixed income assets or bonds, right? And the rest you can decide 40 to 50% equity and 20% whatever else, alternatives, gold, etc. that you want to do. Within that 30% of allocation, I think you should keep 20% in short term. So, you can do 3-month, 6-month deposits like emergency money. You can put on liquid mutual funds, which overnight liquid, which give you like 6%, but that's your emergency money. I do think that 20% should be invested in government securities. And given where we are on the interest rate cycle, which means most likely RBI is going to cut rates further, as we are seeing globally, you should buy long-term, 10 years plus government securities, which give you currently around 6.75, 7%. The reason is that you have actually potential for capital gains on that, right? Because last year, if you bought government 10-year bond at 7.1 and right now 6.5, you've actually made 12% return because you earned the 7% and the bond is probably trading at 105 or 106 right now. So given where you are in the interest rate cycle, you should actually buy long-dated government securities 20%. The remaining, I think you should have no more than 25% in high-yield corporate bonds to give you that. So buy the 2 to 3 year maturity, 11 to 12%, do your work and diligence. And then the bulk of your portfolio, which is another, let's say 35 to 40, should be in AA corporate bonds. AA corporate bonds today give you anything between 7.5 to 9%. So you build a blended portfolio where you have the emergency money, you have the high carry 11, 12%. You buy government securities, which are the safest, but could give you capital gains and give you double-digit returns. And you build a steady income of about 8 to 9%.
Okay. And in terms of fixed deposits, I mean, your views are quite clear on fixed deposits.
Is it?
But the fact is that what about corporate fixed deposits? They offer a higher return than, say, a bank fixed deposit, and somewhat similar to a corporate bond as well.
By corporate fixed deposit, you mean the NBFCs?
The NBFCs,
Yeah.
yes.
Yeah, so fixed deposits come in all shapes and sizes. There are the large nationalized banks or large private banks, to name SBI, HDFC, ICICI, which are very, very tight spreads just given the nature of the beast. I think there are 4 or 5 NBFCs, large NBFCs, which people should go for. Please do not put fixed deposits in small NBFCs or companies. And this information is available as to what is the rating, what is the parent rating, what is the size of the balance sheet, will give you an idea of the size of the company. So don't go for that 0.5% extra. Please do not. It's your money. It's not going to change dramatically. There are a lot of late, or even the fashion was till last year, the small finance banks were giving much higher rates, right? All those rates have collapsed now. So FD's rates have really, really come down, and it's out of flavor for the investors, and with RBI cutting rates further, hopefully, and most likely, FDs, I think, are the worst, not the worst. I mean, they have a purpose. They have a purpose for short-term needs. They have a purpose for liquidity. But you can't get into a 2 or 5 year FD, really, because you lose the flexibility of investment. What do I mean by that? We are in the lower interest rate cycle. You're going to lock your return in an illiquid instrument for a longer term. You'd rather buy a bond because then at least you can exit when you want, or you can change your stance in a year or two. You can diversify and choose cash flows and things that suit your purpose.
So, are the Indian corporate is the bond market liquid enough right now?
Good question. Liquidity, I think, is a concept which not only us but globally we face that, right? So I'll give you some stats. Last year, in financial year 24-25, $200 billion of corporate bonds traded in the secondary market. That is up 25% year on year. This year, again, till September data, we're going to be up another 37%. So perceptions aside, data is telling us that more volume, more activity is happening. Another data, last year there were 11.9 lakh trades in corporate bonds. This year, in 6 months alone, we have 11.15 lakh trades, showing that we've probably doubled the number of trades this year, right? So interest is growing. However, liquidity is a function of risk. So a AAA bond, a government security, we have a very vibrant government security market. You can trade a bond at any minute, any second when the market is open. Now, the lower you go in the rating cycle, if you go to a single A, if you go to a triple B, liquidity becomes a challenge, Again, there are some schemes saying, hey, if you want to exit, we'll buy it back for you. Again, investors, please beware. There's a little line below says subject to market conditions. So which means that the day you want to sell, maybe the whoever is offering you a broker or platform will not be there to buy it back. It's just a little marketing teaser which is going on. So please be careful. So liquidity is growing, but the lower you go in the risk cycle, you're getting compensated for lack of liquidity. You cannot have an absolute liquid instrument which gives you 12%.
Of course. So if you buy, say, if you invest in an 18% bond, then you're stuck.
I think you're holding to maturity.
Holding to maturity.
It's gonna give you an exit irrespective of whatever they tell you.
Yeah. Could you also talk about the functions and the guardrails that are there because of the trusteeship services, and how should retail investors treat these?
Yeah. So there's a concept called debenture trustee, which again post 2020-21 regulations have really become good and very guardrails. A debenture trustee is an independent company which is regulated by SEBI. So these are regulated entities. So when a company issues a bond, it appoints a debenture trustee. The job of the debenture trustee is to look after the interest of the bondholders. Shayan, the information was not available 3 to 4 years ago. The debenture trustee's job is to make sure the company is paying interest at the right time. So in case there's even a delay, they'll quickly these days email like 10,000 investors, this company has delayed. Going to make sure that the redemption or the maturity, the money comes at the right time. A lot of bonds are issued with something called the covenants, which means the company is going to follow these four things, interest coverage ratio, debt to equity ratio. It's the debenture trustee's job, because a common retail investor cannot track a company very, very closely in terms of debt. So if there is a covenant breach, and covenant breaches happen all the time, there's nothing wrong with that, they immediately inform the investors. So debenture trustee is basically I call you your guardian to the investment, right? His job, and he's regulated by SEBI, or their job is to tell you if anything is going wrong from the issuer side. Are they actually following all the commitments they gave you in covenants? Their role becomes also very important in case there's a default. Let's assume that corporate bonds, not assume, it's a fact, would have defaults in the future. And in the recent past, also in India, we've had a couple of defaults this year. In terms of a default, a debenture trustee is very active protecting the interest of the debenture holders, because let's say as an individual, you might feel powerless in front of a company. How does it work? The debenture trustee gets all the investors together. He'll send you an email, say, let's do something. He'll appoint a nominee, and it may decide to go through, which form of recovery. So let's say a lot of bonds are secured. So it's debenture trustee's job to enforce that security to recover money for the investors. Obviously, it does on behalf of a majority of voting investors, but you don't have to wait. If something, let's say, were to go wrong and default, you don't have to say, oh my God, what's going to happen? Who do I call? Debenture trustees are going to call you. They're going to email you. They're going to write to you and say, this has happened. Please come together and let's resolve it together. I think that's phenomenal, because that kind of active trusteeship, I do not see in international markets. We do have trustees in the international market, but I have not seen them to be that proactive. I think the framework that we are setting in India is quite conducive and beneficial to the investor.
So are there better safeguards in the bond market than in the equity markets?
Good question. I'll give you an example. When you buy an equity, what do? You transfer money to your broker, right? And the broker transfers the securities to you. I'll tell you how payments in bond market are better. When you buy a bond, your money actually does not touch the platform. So if you buy a bond in IndiaBonds, the money will not pass through us. Your money, through secured payment gateway, goes straight to the National Clearing Corporation, and they will credit the securities to you in your demat account. So actually, the infrastructure that we've built, thanks to the technological revolution or disruption, is actually safer, because we've had cases where you transfer to the broker and something happens to the broker, and there are safeguards to that. So I will not say that it's better or safer than equity. I just think we've used technology in the latest available fashion and made it better. But classic finance one-on-one, bonds are supposed to be lower volatile and lower returns. Equity is supposed to be higher volatility and higher returns. You have to choose what you want to do.
Okay. One last question, Vishal. So right now, if there's one advice you want to give to retail investors to secure their portfolios against volatility, future shocks, what is it that you would tell them?
I'll give you a stat on this, because people love numbers. So we did this test. Firstly, my simple advice is diversify your portfolio. And by diversification, I mean put 30% of bonds. If you want an optimum financial portfolio, it cannot be one asset versus the other, because you have then concentration risk. So what happens? Let's say Nifty last year, 1 year returns, headline to headline, is minus 2%. If you had bought a bond, corporate bond giving you 10%, it would be plus 10%. That's a 12% return differential. And that helps you to offset the downturns, right? Because this is 25% of my portfolio going to give me 8 to 10% returns. And that, as you know, pays for expenses, helps your wealth to grow in a better fashion. And you do not have to be subject to extreme volatility of other asset classes. So my one advice is do have fixed income in your portfolio to basically, absorb the shocks that other markets, which can give you much higher returns, can do. If you see Nifty in the last 4 years, it's up 45% or 42%. If you bought a 10% bond 4 years ago and reinvested that 10%, it would be up 46%. So you're really, people say equity gives better returns. Absolutely. If you're a rockstar stock picker, or you're amongst the 9% F&O traders in the country who make money, as per the SEBI report, only 9% people do, then it's fine. Go for it. If you're an average guy who wants to build a financial portfolio, and even a smart guy, diversification, put fixed income, put bonds, go away from the fixed deposits, low returns, and move ahead.
Thank you. Thanks, Vishal, for joining us today. I'm sure our viewers will be able to judge risks better after listening to this.
I hope so, Shayan, and thank you for having me over. I appreciate that.